Right now, silver is down 52% from its all-time high, from $121 an ounce to $57. And if you own any silver, or you've been thinking about buying some, that number probably feels like bad news, like the story is over. Except here's what almost nobody's telling you. While that price was crashing, the actual amount of silver available in the world versus how much everyone needs, that gap just hit its worst point in 6 years. Worse than last year, worse than the year before that. A falling price and a growing shortage are not supposed to happen at the same time. One of them is lying. And by the end of this video, you're going to know exactly which one it is and what that means for your money. Hi, my name is Jack. Hope you're doing well. Come for the finance, stay for the metal that's breaking all the rules right now. So let's start with something you probably already have a rough sense of, which is what silver even is used for and why anyone cares about its price in the first place. You know it as jewelry, as coins, maybe as something your grandparents kept in a drawer. That's the old story of silver. The new story, the one that actually moves the price today, is that silver has quietly become one of the most important industrial metals on the planet. It's in solar panels, it's in electric vehicles, it's in your phone, your laptop, and increasingly, it's in the massive data centers being built to run artificial intelligence. More than half of all the silver used in the world today doesn't end up as jewelry or coins at all. It ends up inside factories, on rooftops, and in circuit boards. So when we talk about silver's price, we're not really talking about a shiny collectible anymore. We're talking about a raw material that the modern economy genuinely cannot function without. Now, here's where the story gets strange. At the very start of this year, silver did something it had never done before. It ripped higher, week after week, tearing through the $80 mark, then through $100, and finally hitting an all-time high of $121.62 on January 29th. If you were watching the news at the time, you probably remember the headlines. People were calling it a modern-day silver squeeze, comparing it to that famous moment back in 2021 when a group of retail investors on the internet tried to take on the big banks in the silver market. But here's the distinction that actually matters, and it's the difference between a headline and the truth underneath it. Back in 2021, that squeeze was mostly a social media story. A community of retail traders organized online, piled into silver and silver-related investments all at once, and for a few wild days, they genuinely moved the price and drained physical inventory from dealers across North America. It was dramatic, but underneath it, there wasn't necessarily a severe long-term supply problem driving it. It was more like a flash mob showing up at the same store at the same time. This year's move was a different animal entirely. There wasn't a viral online campaign behind it. What happened instead was that a genuine, multi-year structural deficit, the kind we're about to walk through in detail, finally collided with a financial market that was thin on actual, physical, deliverable metal. When real buyers, industrial companies, investors, and institutions started asking for real silver at the same time that the shortage was already the worst it had been in years, the price didn't just get pushed around by sentiment, it got pushed around by an actual mismatch between what people wanted and what physically existed to sell them. That's a much more serious kind of price move because sentiment can fade in a week. A physical shortage doesn't. Then, just as fast as it went up, it came back down. Hard. By the middle of this year, silver had fallen all the way to around $57 an ounce. That's a 52% drop from the peak. If you're doing the math in your head, that means silver gave back more than half of that entire historic rally in under 6 months. For anyone holding silver or silver mining stocks or a silver ETF inside a retirement account, that kind of drop is the sort of thing that makes you want to close the app and stop checking your portfolio for a while. So naturally, the assumption most people make when they see a chart like that is simple. The price crashed, so the crisis must be over. Whatever drove silver up to those crazy highs back in January, it clearly wasn't real. Because look, it already came back down. Supply and demand fixed itself. Nothing to see here anymore. Except that assumption is wrong. And here's how we know. Every single year, the world's biggest silver research groups, the Silver Institute and a firm called Metals Focus, put together something called the World Silver Survey. It's basically the most trusted scorecard in the entire industry for how much silver actually got mined and recycled that year versus how much the world actually used. And this year's survey confirms something that should stop you in your tracks. The shortfall between what got produced and what got used came in at 46.3 million ounces. That's not a small number, and it's also not a one-time event. This is now the 6th year in a row that the world has used more silver than it has managed to produce. Not the 2nd year, not the 3rd, the 6th. And this year's gap was actually bigger than last year's, which was bigger than the year before that. Think about what that actually means in plain terms. Imagine a swimming pool that's slowly being drained, and every single year, a little more water goes out than gets poured back in. That's been happening with silver's above-ground stockpiles for 6 straight years running. The pool isn't overflowing, it's draining. And the drop in price we just talked about happened at the exact same time the pool kept getting lower. That's the contradiction. That's the thing that doesn't add up. So if the shortage is real and it's getting worse, then why on earth did the price fall 52%? This is actually the most important part of the whole story, because the reason has almost nothing to do with silver itself. You already know that interest rates and the Federal Reserve affect the stock market. What a lot of people don't realize is that they affect metals like silver just as much, maybe even more. Here's the simple version of why. Silver doesn't pay you anything just for holding it. It doesn't pay a dividend. It doesn't pay interest. So when interest rates are high and you can just put your money in a savings account or a treasury bond and earn a guaranteed return, holding silver becomes less attractive by comparison because you're giving up that guaranteed income to hold a metal that just sits there. Earlier this year, the Federal Reserve, under its new chair, took a noticeably tougher stance on interest rates, and a hot inflation reading in May reinforced the idea that rates were going to stay higher for longer than people hoped. On top of that, the US dollar got stronger, and when the dollar strengthens, commodities priced in dollars, including silver, tend to get cheaper almost mechanically, the same way a foreign vacation gets more expensive for you when your home currency weakens. Now here's the part that I think is genuinely fascinating, and honestly, a little ironic. You'd think that a war, like the one that's been unfolding in the Middle East this year, would be good for a metal like silver, because wars usually push investors toward what are called safe haven assets, things people trust when the world feels unstable. But this time, the war actually worked against silver. Here's why. The conflict pushed oil prices higher, and higher oil prices push inflation higher. And higher inflation gave the Federal Reserve even more reason to keep interest rates elevated instead of cutting them. So instead of the war scaring people into silver the way it might have a decade ago, it actually reinforced the exact conditions that were already pushing silver's price down. The safe haven story got completely overridden by the interest rate story. So to summarize where we are so far, silver's price crashed because of interest rates, the dollar, and inflation expectations. Pure financial plumbing. Meanwhile, the actual physical supply and demand situation for real physical silver bars sitting in real vaults did not improve even slightly. If anything, it got tighter. 2 completely different forces, pulling in 2 completely different directions, and the one that won in the short term was the financial one, not the physical one. But it gets even more specific than that, and this next part is where China comes into the picture. Because China isn't just a big player in the silver market. China controls somewhere between 60 and 70% of the entire world's refined silver supply. That's an extraordinary amount of concentration for a single country to hold over one commodity. And starting on January 1st of this year, China's government put a new rule in place. If a company wants to export silver out of the country, it now needs a special government license. And they didn't hand these licenses out generously. Only 44 companies in the entire country were approved. And to even qualify, a company needs to be producing at least 80 tons of silver a year and holding tens of millions of dollars in available credit. That effectively locked out all the smaller players and left only the biggest, most established firms with permission to ship silver overseas at all. Think about what that does to the rest of the world. If the country that controls the majority of global refined silver suddenly makes it significantly harder for that silver to leave its borders, the silver doesn't disappear, but it becomes a lot harder for factories in the United States, Europe, and everywhere else to actually get their hands on it. And we can actually see the fingerprints of this policy in the data. In markets like Shanghai, where silver trades inside China, the price has been running about 10% or more above what silver is trading for in Western markets like New York and London. That gap between 2 prices for what's supposed to be the exact same metal is the market's way of telling you that silver inside China and silver outside China are no longer flowing freely between each other the way they used to. When you see a persistent price gap like that between 2 places that should be connected, it's usually a sign that something structural is blocking the connection. Now let's bring this back to the vaults themselves, because this is where the story gets almost impossible to ignore. There's a place in New York called COMEX. It's the largest precious metals exchange in the world, and it's where most of the futures contracts for silver actually get traded and settled. Inside COMEX-approved vaults, silver gets split into two categories. There's what's called registered silver, which is metal that's immediately available to be delivered if someone wants to cash in their contract for the real physical thing. And there's eligible silver, which technically meets the exchange's standards, but isn't set aside for delivery. Back in 2021, the registered category, the stuff that's actually ready to be handed over, was sitting at a certain level. Since then, it has fallen by more than 70%. 7-0. More than 2/3 of the immediately deliverable silver in the largest vault system on Earth has been drawn down over the past several years. And here's a number that I think really puts the whole picture into perspective. Some analysts who track this closely estimate that for every single ounce of physical silver that actually exists and is accounted for, there are roughly 350 ounces worth of paper contracts and financial claims trading against it. 350 to 1. Now, to be fair, that doesn't mean the whole system is about to collapse tomorrow, because most people trading these contracts never actually want the physical metal delivered to them. They're just trading the price. But it does mean the market for silver on paper is enormous compared to how much actual silver backs it up. And when even a small percentage of paper holders decide they want the real thing instead of just a contract, that's when you start to see exactly the kind of stress and price spikes we saw back in January. So now let's connect all of these threads together, because individually they're interesting, but together they tell a much bigger story. You've got a structural shortage that's persisted for 6 straight years and just got worse. You've got the world's dominant supplier, China, actively restricting how much of that limited supply is even allowed to leave the country. You've got Western vaults that have been quietly drained by more than 70% since 2021. And you've got a paper market that's built on a foundation of real metal that keeps getting thinner and thinner relative to all the promises stacked on top of it. None of that changed because of a Federal Reserve meeting or a strong dollar. Those things affect where the price sits on a screen in the short term. They don't affect how much actual silver physically exists in the ground and in the vaults. This is the disconnect. The price you see quoted every day reflects what traders, interest rates, and currency markets think silver is worth right now, today, based on financial conditions. But the physical reality underneath that price, the actual tug of war between what gets dug out of the ground and recycled versus what factories, solar companies, and electronics makers actually need, has continued getting tighter with almost no interruption. Those are two different conversations happening about the same metal. And right now, the conversation that's winning is the financial one, not the physical one. Here's why that matters for you, even if you've never bought an ounce of silver in your life. Solar panel installations are expected to hit a record high this year, and every single one of those panels needs silver to conduct electricity efficiently. Electric vehicles need more silver per car than traditional gas-powered ones. And the build-out of AI data centers, the same story you've probably heard about in the context of electricity demand and computer chips, also quietly leans on silver for wiring and components. None of these industries can simply substitute something else in easily. Silver has properties like being the best natural conductor of electricity of any metal on Earth that make it genuinely difficult to replace at scale without a real cost or performance trade-off. So the demand side of this equation isn't going away. If anything, based on how fast solar and AI infrastructure are being built right now, that demand is going to keep climbing for years. There's actually a useful comparison here, because this isn't the first time in history that a critical metal has run a supply deficit for years while its price did something completely different in the short term. Think about how basic economics is usually taught. When something becomes scarce, the price is supposed to rise to reflect that scarcity, plain and simple. But real markets, especially metals markets, don't always work that cleanly in the short run, because the price you see quoted on any given day is set by whoever is trading contracts at that exact moment, not by a slow, careful accounting of how much physical metal actually exists in the world. Those two things, the trading price and the physical reality, are supposed to reconnect eventually. The question is never really whether they reconnect. Historically, they always do. The real question is how long the gap between them can stay open, and what finally forces it closed. With silver specifically, Part of the reason mine supply can't just ramp up quickly to fix this deficit is something most people don't realize about how silver actually gets produced in the first place. Unlike gold, which is very often mined specifically because a company is looking for gold, the majority of the world's silver doesn't come from dedicated silver mines at all. It comes out of the ground as a byproduct of mining for other metals entirely, mainly copper, zinc, and lead. That means mining companies can't simply decide to produce more silver just because the price goes up. They're really just digging for copper or zinc, and the silver that happens to come along with it is almost a bonus. So even when silver prices spike, the supply response is slow and limited, because it's tied to decisions being made about entirely different metals for entirely different reasons. That structural quirk is a big part of why a 6-year deficit hasn't simply fixed itself the way basic supply and demand would predict in a textbook. Now, I want to be fair here and walk you through the other side of this argument, because it's important, and because I don't think you should just take my word for any of this without hearing the counterpoint. Not everyone agrees that this ends in a repeat of what happened back in January. Some analysts point out that the massive squeeze earlier this year already happened once, and prices already came back down significantly since then, which means a lot of the excess speculation and leverage that built up has already been washed out of the system. There's also a fair argument that if silver's price does spike again, higher prices themselves tend to slow down demand, because industries that use large amounts of silver start looking harder for ways to use less of it, or substitute it where they can. And that process over time naturally cools off extreme price moves. Multiple major banks, when you look at their forecasts for silver over the rest of this year, are generally landing somewhere in the $55 to $70 range, which suggests most professional forecasters expect stabilization rather than another dramatic spike in the immediate future. But here's the thing about that argument, and I think it's worth sitting with for a second. Even the more cautious, stabilization-focused forecasts are not predicting that the shortage itself goes away. They're predicting that the price might behave more calmly while the shortage continues. Slowing demand growth because of higher prices is a real phenomenon, but it takes years to meaningfully show up, because you can't redesign a solar panel or an electric vehicle's electrical system overnight. The deficit we've been discussing, the 6th straight year of the world using more silver than it produces, is a slow-moving structural problem. It's not something that resolves itself in a single financial quarter just because the Federal Reserve changes its tone on interest rates. So where does that actually leave things? I think the most honest way to put it is this. The next time interest rate expectations shift, whether the Federal Reserve signals cuts are coming or signals they're going to stay higher for longer, you're likely to see silver's price react to that news the way it always does, moving up or down based on what investors think the dollar and interest rates are going to do. That's the financial layer, and it can be genuinely unpredictable in the short run. But underneath all of that noise sits the physical layer, the actual tightening supply, the actual restricted exports, the actual draining vaults, and that layer doesn't reset just because the price had a rough few months. If those two layers, the financial one and the physical one, ever line up again at the same time, the way they briefly did back in January, when the price spiked to that all-time high, the move could be significant, simply because the underlying shortage has had 6 more years to compound since the last time this happened. I'm not telling you this to create panic, and I'm genuinely not telling you to go buy silver tomorrow morning. Markets can stay disconnected from physical fundamentals for a long time, sometimes for years, before those two things reconnect. What I am telling you is that if your only information about silver came from glancing at a price chart that shows a 52% crash, you were only seeing half the picture. The other half, the physical shortage getting worse for 6 consecutive years, the world's biggest supplier restricting exports, and vaults that have been quietly drained by more than 70%. That half of the story hasn't gone anywhere. It's still unfolding right now, completely independent of whatever the price happens to be doing on any given day. So which one was lying to you? The crashing price or the growing shortage? Honestly, neither one was lying exactly. They're just answering two completely different questions. The price is answering the question, what do financial markets think silver is worth today, given interest rates and the dollar? The shortage is answering a totally different question. Is there enough actual silver in the world to meet everyone who needs it? Right now, the answer to that second question is no, and it's been no for 6 years running. Whether the price catches up to that reality soon or keeps drifting along based on whatever the Federal Reserve does next, that's the part nobody can predict with certainty. But now you know what to actually watch for, and you know it's not just the number on the chart. Thank you so much for watching. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already, and I'll see you back here very soon.